Hello and welcome to this extra edition of The Firm this weekend. Earlier this week, the Ministry of Corporate Affairs released final rules for 10 or 11 chapters of the Companies Act 2013 to bring you the highlights and the most important impact areas. I have with me today three of the handful of experts in this country who have actually read the rules. Narayan Shankar of M&M, Venkateshwaran of KPMG and Darshan Upadhyay of ELP. Gentlemen, to all three of you, a warm welcome. We have lots of ground to cover, so let's get down to it. The most important change that has taken place and the biggest positive in this set of final rules is the toning down of the definition of related party and relatives. So in the definition of the related party in final rules, they have dropped or disincluded directors and key managerial personnel of subsidiary and associate companies and their relatives, as well as senior management and holding subsidiary and associate companies. These have been disincluded. In the definition of relative, they have now restricted relative to just one generation above and below, which is your parents and your children, largely speaking, are part of the relative family. In doing so, Mr. Narayan Shankar, they have reduced the scope of what would constitute a related party transaction and brought considerable relief to corporate India, correct?
Sure. A huge relief, Menaka, both in terms of the universe of related parties as well as introducing materiality concept to the transaction where you have to take shareholders' approval. Earlier, besides the relative and the key managerial personnel that is looking down, they have even today included common directorships with 2%. That is, if merely because an independent director is a common director between two listed companies, they are not going to be treated as related party unless the directors and relatives together hold more than 2%. That's a huge relief. It's not merely common directorship. It's an alignment with accounting standard 18 in a manner of speaking. Relatives, definitely it's come earlier 20 plus, it's come down to 15, now it's come down to 8. Father, mother, brother, sister, son, daughter, their spouse, husband, wife, HUF. Broadly, this will be the universe. Industry had recommended for financial dependence because independent directors, auditors, all are going to be, there are penal provisions, specifically those relatives where you do not have control. So these three definitely a huge plus, and added to that, as I said earlier, all transaction which needed to go to the board also had to go to the shareholders. So today for goods and materials, they've introduced a threshold of 25% of the turnover. For removable properties, there's a 10%. Similarly, for services, there is a 10% threshold, which all gives you a leeway to say that you can go ahead without shareholders' approval. Administratively, I thought that was a huge relief.
Okay, you spoke of transaction thresholds, and I'm in fact a little disappointed because it does seem that they have now put in materiality thresholds for those transactions that need to go to shareholders for a special resolution, right? So they've said, for instance, that the sale, purchase or supply of any goods or materials that exceed 25% of the annual turnover would need to go to shareholders for a special resolution, which includes majority of the minority because the disinterested party cannot vote. Or the selling or disposing of property of any kind which exceeds 10% of net worth. So are they saying that only these very large transactions in context of the size of a company need to go to shareholders for approval via a special resolution, and that's where the majority of the minority kicks in, and thereby reducing the number of RPTs that in fact come to shareholders? Because that seems to be like a 180-degree turn from what we had anticipated RPTs would be, right?
The intention appears to be to give relaxation to corporates, but the manner in which it is worded, because you're talking of a 10 crore capital, which is a small threshold. The manner in which it is worded, 10 crores or such transactions, perhaps gives a slight iota of doubt.
So you're saying that there are two thresholds here. If you're a company with 10 crores and more in paid up capital, and then if you do an RPT which exceeds these transaction thresholds, only then will those RPTs go to shareholders for special resolution approval.
One way of looking at it.
That's how you're reading it. Are you reading it like that, Sai?
Exactly. So
or you're reading it saying either you are a company with 10 crores of share capital and hence all your RPTs go to the shareholder for approval, or you are 10 crores and you breach these materiality thresholds and only then do the transactions go to the shareholder.
So I think that these are two independent kind of criteria, but if you breach 10 crores, then every transaction which is not at arm's length and not in the ordinary course of business will have to get reported to shareholders. So even if it is only 5% of your turnover, but because your share capital is more than 10 crores, you will need to then
So
defer
you're
that.
saying these transaction materiality thresholds apply only to those companies where the share capital is 10 crores
10
or
crores
less,
or less.
less than 10 crores, right?
Absolutely, yeah.
Otherwise, all companies with share capital of more than 10 crores, all
Automatically,
RPTs
yes.
will end up going
Yeah,
to shareholders.
Absolutely.
That would cover the listed universe in this country pretty
I
much,
agree,
Darshan. So
Menaka,
that means
and
all listed companies having all those RPTs which are not in the ordinary course of business or not at arm's length would need shareholder approval via special resolution, leaving out the interested party.
I tend to agree with Sai, Menaka, because the way in which the Act is worded, where they were supposed to prescribe a threshold through a rules, and now they have done that. It's
But
not a
these
cumulative.
transaction materiality thresholds that make no sense because they only apply to those companies which have a share capital of less than 10 crores, right?
Yeah.
So they've set out all these transaction materiality clauses, which is why I'm inclined to believe what Mr. Narayan Shankar is telling me, that maybe the ministry said, no, look, above 10 crores, and then when it comes to transactions above all these sizes,
that
then
may
you
be
go to
an
shareholders.
intent, Menaka, but that's not how it
The wording
probably
doesn't
reads,
say
yeah.
so. Okay, so the
And I
wording
think
is
the
in
thresholds
your
are
corner.
so high
the
that I
intent may
think
be
there
in.
could be several transactions that are relevant to minority shareholders which will not get caught in that 25%.
That's why I was
absolutely.
disappointed at the first reading of this.
So, but if you read it together with the share capital threshold, I think it's a fairly balanced.
Okay. The one thing I wanted to pick up as well is what I'm calling the MARUTI fix, which is that they have now required for the company to place before the board the manner of determining the pricing and other commercial terms of the related party transaction before the board can give it approval. So in a sense, what we saw happen in the January meeting of MARUTI.
Yeah, probably will anyways have gone to the board.
So all such agreements, you would have to give all the finer details to
The pricing, all commercial terms, all of that, and every other factor that's been considered in making that decision. I think all of that needs to be put out.
Okay, so I actually do hope that it's your interpretation that prevails and not yours, sir, because from the governance point of view, at least these transactions and they'll come to shareholders for approval. Are we done with related party transactions?
Just one more, in the subsidiary definition, they had earlier used the term total share capital. Now they've restricted it to only convertible preference share.
Right.
Here again, in alignment, of course, it would
So
have
now
been
they've
best if it
included
would have been
preference
compulsory.
shares, but they've said convertible preference shares. Earlier preference shares were not included at all in the calculation of
Vice
total
versa,
share.
preference share, entire preference share and equity share capital was included. That would be the denominator. And even if you hold zero equity and hold 100% of preference, that could be a subsidiary. So today they're saying only those preference shares which are convertible. Ideally, it should have been compulsorily, not at the option, but that's one change.
Okay.
Things which have not been fixed today is, of course, like he mentioned, what is the interested related party? Because if it is a holding company and an associate, if both can't vote, there's a deadlock. Second, in terms of related party, relative financial dependence would have been better, but of course that's not common.
Yeah, that you mentioned already, sir. Okay, so I think that pretty much wraps up the key areas around RPTs. The second big area of relief has to do with intercorporate loans and guarantees, and this is relief for Section 185, 186. Those of you who have been watching the buzz around these two, and this relief has come through the rules regarding loans to directors, where they seem to have exempted loans by the holding company to wholly owned subsidiaries, guarantees and securities by the holding company to wholly owned subsidiaries and subsidiaries, not just wholly owned, and in one instance also joint ventures. So this issue that was plaguing intercorporate loans and deposits is gone, sir?
I think to a large extent, I think it puts that to rest, because I think corporates are genuinely faced with a difficulty in being able to, I think, financially lend support to their subsidiaries, either through direct loans or otherwise giving guarantees in regarding loans that were being taken by them. But I think that's now gone away with, I think, this the rules now clarifying that I think those are kind of exempt from Section 185. Now, the legality of something is something which I think people will keep questioning, but I think it does go in.
Legality as in how are the rules amending the Act?
Absolutely, because the Act contains a very specific provision, and compared to Section 295, these were two exemptions that were taken out. And now through the rules, you've brought those exemptions back. So I think whether it's valid in that sense is something that will continue to be questioned. But otherwise, from a practical perspective for companies, I think it does provide a great relief.
Darshan?
I don't think, Menaka, it gives complete relief, because when you see the two MCA clarifications which came out on 185,
the
grandfathering ones. Let's say we had to give loans where we had common directors. It's a part of group. Let's say a big group company which has multiple entities, and one entity needs to give loan to another, maybe either common directors or they meet the test. Is there a clarity that after 186 coming in, you would be allowed to do that, or you will still rely what people are doing on whether it's ordinary course of business, whether it's loan at meeting the interest rate. It's either the question is it completely barred for that group entities, or you would still rely on that exemptions to go ahead and do it?
You're nodding your head.
No, I'll only make one deviation from what he's saying. Ideally, they could have clarified to say that once you get into 185, because loans is specific, there is a provision and rules of interpretation are very clear on that. You need not go to the generic provisions of 188 related, because once you're coming into that. But to come to the other point of whether everything has been settled, unfortunately, they have bifurcated between loans and guarantees. Loans and guarantees to wholly owned subsidiaries done. It's exempt. But as far as subsidiaries are concerned,
only guarantees and
because perhaps the banking industry had an issue of giving a bank guarantee to a company based on the holding company's guarantee, MCS perhaps addressed that issue by saying that if you're giving a guarantee to a subsidiary, they have added two further conditions which was there in the earlier circular. A, it has to be a bank or financial institution. So what happens to other lenders? Answer is zero. Other lenders can't be. And B, it has to be used by the subsidiary for their principal business activities. These two additional conditions not defined. And of course, here are also rules perhaps going.
So you got part relief when it came to intercorporate loans and guarantees. Only part relief. And the grandfathering bit is still a sticky one, saying exactly what has been grandfathered and what has been extended by 1 year is still a slightly confusing area. Right?
In fact, the principle...
I would get into it, but I suspect it will take us 45 minutes to explain all of it, right?
Then in fact, so that use for the principal business may not be something new, because they already clarified it in the last circular which came up under 185, and probably they are just reincorporating what they thought was.
Okay, the third big important and again positive change is the change to the depreciation schedule. And if I've understood this correctly, Sai, earlier the schedule prescribed what would be the life of the asset. Now they've said this prescription is not a prescription, it's only indicative, and the company can decide what would be the life of the asset and therefore the duration of depreciation. Have I understood this correctly?
So
big relief.
Big relief. And the reason it's a big relief is when the original schedule was kind of drafted, it essentially, in its applicability section, I think spoke of two classes of companies. One to which a specific set of standards were to apply, which meant Ind AS or IFRS equivalent standards when they came in, and the other class of companies. So since Ind AS is not a reality today, every company fell into that residual class. And the residual class could only use a life which was equal to or shorter than the life indicated in the schedule. Whereas the first class could use a life longer than what was in the schedule as well. So as a result, I think companies were all constrained to use a life which was equal to or less than the schedule. And the life of the assets indicated in that schedule had actually come down significantly. For instance, continuous process plant came down from 19 years to 8 years. So imagine a cement plant having to be written off in 8 years when they technically probably run for 35, 40 years.
Fair enough.
So practically companies would have been faced with a situation where their entire net worth or their fixed asset base overnight has to get wiped out. Their fixed asset coverage ratios would have gone for a toss. Loan covenants would have gone for a toss. So I think it is a big issue that actually came through.
So what they've said now is that we've said 8 years is the time period in which you need to depreciate that cement plant. But you can pick a life of the asset of your own. Right?
Absolutely. So now they've said that every company to which the schedule applies can either use a life longer than or shorter than. You just need to provide justification in your
so you can use 18 even though they've written 8 as indicative, as long as you can explain why.
So one of the other changes is specifically on continuous process plant, the 8 has been changed to 25.
Oh, lovely. Okay, so that in itself is an improvement, and even if 25 was not enough for a particular industry, they could have said, well, we're going to depreciate this over 35 years. This is our justification, and the ministry would have looked at the justification.
Absolutely,
right?
That's the...
So huge relief.
It's a big relief, and I think a big practical step taken there. The other thing that they've done is also on intangible assets. So earlier under the Schedule 14, they had come out with a clarification relating to some of the infrastructure projects, the toll roads and all that, and they had spoken of a method of amortization to be used there. So they have again incorporated those same kind of requirements within Schedule 2. So again, that comes as a big relief for companies.
Now we're going to each list one or two other key important impact areas in the hope that we can cover some more of these rules. I think on my list was private placements. They have changed the environment for private placements considerably. We've discussed that in a previous episode. What they've done in the final rules is they've taken away the restrictions on the number of private placements you can do in a year or in a quarter. They've also taken away the restrictions on the secondary transfers. Earlier there was a secondary transfer restriction saying you could only pass it on to 20 people. Now they've taken that away. So in effect, secondary transfers could be unlimited, right? Ms. Narayan Shankar, you want to list one or two of the key other impact areas?
Key other impact areas, one thing which we didn't perhaps for 186 loans and investments, a key major improvement is loans, investments and guarantees to wholly owned subsidiaries did not go to the shareholders' approval, A. B, what happens to if you're doing your limits again on 1st April, they have given you a time period of 1 year to seek approval of shareholders. Because a lot of exemptions which were available under the 1956 Act, not available in the 213 Act, 2013, they've given a period of 1 year, which is a huge positive. Coupled with an omnibus resolution, which they say that you need not have to name the subsidiary, name the and terms. Those terms can be defined in the annual report.
Okay, shareholding disclosure you said is
shareholding disclosure again for top 10 shareholders and promoters today they have introduced a materiality concept of 2%, which
Explain
is earlier any change happening in top 10 shareholders because you get a bend pause at the weekend and you will have to really keep watching what are the changes which happened between 2 weeks and give it to the registrar of companies. Today they say only give those changes which cross.
Changes in shareholding, which cross 2%.
2%.
Okay, fine. So they brought that aligned. I know you have two other points, but I'll get to them in just a bit. Darshan, what would you like to add quickly to this?
Since you started with private placement, Menaka, I would like to add that with a hope that a lot of investments will go through once this elections are over, I would like to say they have specifically in the rules added a provision in addition to a special resolution that you would anyways need now for even a private limited company to do a private placement. It seems to indicate that a whole lot of different process will also have to be followed, which is to make an offer letter to investors, to get their consent, which is provided under section 42 of the Act. Now, very difficult for an investor to agree to an offer letter or the terms without signing a binding contract with them, having CPs and all. So what this will do is probably either someone will have to take a view to say that because it's independent to 3 investors, although you sign the same agreement, section 42 of the new Act doesn't apply and the special resolution is the only condition you have to meet. But if it's not so, then you will have to have a binding contract ready at the time when you send it to your investors for getting an approval for offer letter.
So it makes the process of preferential allotment more complex and difficult.
Even for private companies and public unlisted companies.
Okay, fine. Sai?
So one thing I want to add is on the internal financial controls, again something which has not been very much talked about. So that's a term I think which has been referred to in 3 places principally in the Act. One is on the kind of duties of the charter of the audit committee and independent directors. So for them they have the responsibility of monitoring that companies have internal financial controls. The directors report for listed companies need to talk of the adequacy and effectiveness of internal financial controls. Right. And thirdly, the auditors for all companies have to comment on the adequacy and effectiveness of these controls. Now this, the definition contained in one of the sections actually goes on to say that this is much wider than just controls on financial reporting, but looks at the orderly and efficient conduct of business, and therefore it looks at operational controls.
So therefore the phrase internal financial controls became a catch-all for all kinds of controls, right?
Absolutely.
Including regular business process, which had nothing to do with financial
controls. Including effectiveness of your sales process.
That's been toned down in the final rules?
So in the final rules, I think in the place where they talk of the director's report, I think they've said that for companies, listed companies and companies with a turnover, with a share capital more than 25 crores or so, they've said that they need to comment on internal financial controls with a reference to the financial statements. Okay. So in some sense they seem to be narrowed
the meaning of the phrase, so to speak, only pertaining to the director's report.
We still need to see what the auditor's requirements are. I think Chapter 10 rules are still awaited.
Yeah. Okay. Independent directors I know was on all 3 lists that you all sent in to me, and that is that the rules now take away the need for 1/3 of the board to be independent. This is for non-listed companies, so public and private companies. And they've now said that you must have a minimum 2 independent directors on board, right? I can't see why that's such a big deal, but if one of you wants to tell me in 30 seconds why...
It will just be a problem for small size and medium size boards where you have 3 directors, and if you have to add 2 directors of independent directors, it will enlarge.
5. So you're saying it should have been 1/3 or 2, whichever is minimum.
And second thing they've still not done is they've not defined what is pecuniary relationship. Unlike SEBI, where they've clearly defined what is and there's a materiality concept 1, and 2, pecuniary relationship under SEBI clearly defines remuneration which you get other than what you're entitled to as a director.
Okay.
So if it is not defined, even commission, if you give it to an independent director, he may get caught in the web and maybe perhaps disqualified. So that definition could perhaps
come. You don't pay him
come.
anything. You don't pay him ESOPs, you don't pay him commission, he gets only
and
sitting
who will
fees.
come for it?
Yeah.
He's allowed to be paid
20
all that
lakhs to attend the meeting, right? Okay.
The other challenge on independent directors is that the threshold for public companies that are required to have independent directors has come down significantly. So earlier draft rule said 100 crore capital, now that's been reduced to 10 crores.
So the universe of companies that need to have independent directors on board has widened.
Has widened.
Okay. We're entirely out of time, though I know we have so much more we would like to cover. I'm going to give the last word to you, Mr. Narayan Shankar, simply on the ease of being able to comply with this set of final rules, given that half the rules for those chapters that have been notified already are yet not out, and it's Saturday. We're 3 days away or 2 days away from the end of the month and the beginning of the next month when all of this comes into effect, and we don't have all the rules of the game.
Yeah. Industry is grappling with the situation of a short time frame in which they have to comply. Of course, this first capsule of rules is really a painkiller.
Because it's a huge improvement on the draft.
But
so we'll give them that.
If you say that you have to go through the act plus the rules plus the circular plus the clarification sometime, which itself is a law by itself sometimes, many of the clarifications and the removal of doubt, you have to interpret it and comply it within 3 days.
And now you've only got half. So actually you've got Sunday and Monday for the balance half.
And
whenever
coupled
it gets
with that,
puts out.
You just imagine it's a year end where the entire team is involved in a year end process. And a Sunday and a holiday is coming in between, and 1st April you'll have actually to be ready for compliance. Huge challenge, I thought.
So you're smiling, but it's actually more painful than it seems.
Yeah, of course.
All right, gentlemen, we'll leave it there. Thank you so much for trying to explain to us in barely 20 minutes what these rules mean. This is just part 1. As we get more rules, we'll come back to you with more analysis.